So, thank you all for joining us. The topic of the panel is Beyond the Gold Rush, How to Survive the Digital Assets Wild, Wild West. And we have a really great lineup of panelists today. Why don't we just go through brief introductions, who you are, who you work with, so people have some background into who's up here.
Sure. So I'll start. Thomas Borrel, Chief Product Officer at Polymath. Polymath is a security token issuance platform. We've been doing security tokens for a couple of years now. Built on Ethereum, about 185 tokens created to date, and we're now in the process of building a purpose-built security token blockchain.
Hello everyone, Dotun and Rominiyi here, and I'm representing the London Stock Exchange Group. I'm sure you all know who we are. And my team essentially are leading the group technology initiatives around emerging technologies, specifically looking at DLT and blockchain, as well as other use cases. So.
Good morning everybody, Lory, Kehoe, Managing Director of ConsenSys in Ireland. ConsenSys is a primary blockchain technology company focusing now specifically on creating blockchain-based products.
Morning everyone, I'm Shobhit. I'm from Citigroup, where I've been working on experimentation and incubation of some of our initiatives around blockchain. I started out my career as an open source developer many years ago. Wasn't very good at it, so moved to things that I found easier. So looking forward to this discussion.
Right, and again, I'm Jor Law. I'm actually trained corporate securities attorney, and the last few years I've spent most of my time just consulting with blockchain companies and other companies, either building out product or building out teams. So let's get into it. You know, the topic of the panel was not one that I chose, but I thought was pretty interesting. And what is the state of the market? You know, we've got some folks from different jurisdictions here. What is the state of the market? Are we really in the wild, wild west still? Were we ever in the wild, wild west? Are we out of it yet? And then also, kind of, since we have the fortune of having a few folks from different jurisdictions, what sort of jurisdictions are you guys looking at and do you think are like friendly toward the regulations are friendly toward crypto or digital assets? You know, what's the state of the environment, basically?
Sure, so I can start. So, you know, I think we need to distinguish, when we talk about digital assets, we need to distinguish cryptocurrencies from securities. There are some fundamental differences from a regulatory standpoint, which is why, you know, bringing the jurisdictions is absolutely crucial. But there's also differences in how that asset gets handled. And one of the biggest differences that we've seen and through our engagement with market participants has been that ability to move the asset even though you don't own the private key, right? So being able to recover assets that were lost, revert transactions that were done illegally or inappropriately. And so when we look at the state of the market in general, there is a difference jurisdictional-wise from a clarity in regulation. But what we can see sitting on top of that are common grounds from a technology needs as well as implementation to support a variety of jurisdictions. So you were asking, you know, which ones are the friendliest. We've seen a tremendous amount of progress from a regulatory standpoint in Europe, particularly here in the UK. The FCA has been very open and clearly technology agnostic around what was the realm of the possible. So we've seen the UK, we've seen the broader Europe as well through their crowdfunding rules that are far more open to digitized security tokens with the ability to raise anywhere between 5 and 8 million. So a much better environment, if you will, here within the UK and within the EU than other jurisdictions through clarity in regulation, as well as a framework that allows inclusion and access to a broader access of investors.
I think I would echo some of Thomas's points. I think just again separating out a distinction between what's happening on the kind of security side and tokenization of existing assets versus, you know, your cryptocurrencies and crypto assets. And I think on the security side, I mean, we've seen very much from an institutional perspective a real transition from focusing on the underlying technology post, you know, an initial analysis and almost kind of a version of the crypto assets and cryptocurrencies to really exploring, you know, how the technology itself can be valuable to solve, you know, use cases around automation and building operational efficiencies. And now we're seeing a lot of businesses really focusing on how they can leverage the technology to really realize the value of digital securities and exploring models where these things can be issued cheaply, can move more efficiently, can provide value around automation of asset servicing, corporate actions, and dividend distributions, and various other facilities that really can both bring down costs as well as open up the market and democratize access to finance for a larger kind of profile of businesses. And I think a lot of the exploration has essentially been orientated around a view that obviously these assets are securities, regardless of the underlying technology or otherwise that may underpin them, and therefore the existing regulatory regimes still hold. A lot of the regulators have pretty much echoed those sentiments across Europe and beyond. Separately on the crypto asset side, I think that there's still a fair amount of kind of solidification of the position that from a regulatory perspective, they're still outside of the perimeter of your securities regulators and financial markets regulators. There's been some maturation of kind of regulatory regimes, mainly focusing on AML, KYC, and anti-terrorist financing, which ultimately it's all around consumer protection. You know, you have these global networks that are entirely pseudonymous, and there are no provisions to prevent money laundering or prevent people from getting their assets stolen. And obviously there have been precedents of these things happening. So it's trying to find ways to build more protection, and then separately to that, exploration of areas to ensure that there are mechanisms to manage tax treatment. But also, if you look at the UK Jurisdictional Task Force put out a legal statement recently on crypto assets and smart contracts, and a lot of the considerations there were around the legal definition of ownership and how that applies to digital assets, and just recognising that yes, they do classify as property in the UK at least, and similarly we expect to see similar positions taken by regulators across Europe. There's obviously a lot of exploration around stablecoins. If you look at the Libra initiative and how that's kind of galvanized regulators to really invest and accelerate in analysis of these assets in terms of what they represent, which has kind of also kicked off a big move towards building taxonomy around digital assets, so we can start to understand how they kind of flesh out and how they can be treated differently. And I'll stop there.
Look, what would I say here? I think to address the question specifically, is it the Wild West still? For me, the answer is probably it was, but it is no more. Not to say that it's a done deal and it's done and dusted. It is definitely evolving, and regulation, I think probably everybody in this room would say, is a welcome development for what we do and how we do it. It is actually a good thing, and will enable us to, I guess, develop other applications, other products as we go. So it's actually a welcome thing. Sometimes people think that technology companies and the work that we do, we're averse to that. We're absolutely not. We're embracing it. It helps what we do. So if you look at a very kind of quick whistle-stop tour of the world, if I will, maybe 5 or 6 places, going from perhaps east to west. If you look what's going on in Hong Kong, we have the Securities and Futures Commission providing licenses for crypto asset platforms. That's a big deal. That's a development, right? We look at France, we look at them having a legal register for assets. That law has passed. That's a big deal. We look at the UK in terms of the property piece or the tradable property. That is a very important piece. We look at the smart contract being legally enforceable here in the UK. That's a big development. We look over to the US, we look at the CFTC and the work they're doing. So Bitcoin as a commodity, Ether as a commodity, Bitcoin futures in 2020, we'll have Ether futures. The list is growing. Then we get on to the European Commission. They have 3 projects underway. 1, which is the European Blockchain Partnership. 2, they have an initiative called the EU Blockchain Observatory and Forum, which ConsenSys is proud to be part of. And that's all about helping identify use cases, inform policy, and educate the Eurozone members. And thirdly, they're actually sponsored a global program called, I didn't come up with this, the International Association of Trusted Blockchain Applications, or INAPA, but it is a European Commission-backed initiative to help the global adoption of blockchain technology. These on their own, they're kind of interesting, but it's just wave after wave after wave of governments and regulators making very clear stances on digital assets. And this is great.
Yeah, I would echo some of the points that Lory was making, because when I look at this space, I look at what the direction of travel is, right? And if I think about the direction of travel over the past 12 to 15 months, I feel more and more positive about this space. Not only not only we are seeing maturity from the technology vendors in this space, we're seeing a very well-rounded discussions with other market participants, financial market infrastructure, other financial institutions, custodians, and the likes. And the discussions are not just about disintermediation, but the discussions are about what does the market structure look like in a world where every security or every asset is tokenized. So it's certainly moving in the right direction, probably not moving at the speed that all of us in this room would like to move it at, but it's certainly moving in the right direction. Secondly, I think with the amount of initiatives going around taken by various governments, regulators, and financial services industry as well, I think it's beyond the point where there is hesitation or concerns around the technology itself. I think the stakeholders have generally bought into the potential of this technology. Now, there's certain questions around, I think for me, market structure is a big question, because it's still not clear what trading conventions would be, whether assets would be traded on a T+0 or T+5 second or T+1 hour or T+1 basis, because there are benefits and drawbacks of each of these. So it still remains to be seen how it goes up, but a lot of it, how it evolves, will be driven by regulations. Now, I know regulators tend to get a lot of flack from the wider community in terms of what they're doing or what they're not doing. But if you think about the job of a regulator, right? Regulators are technologically neutral, right? Whether an asset exists in a physical form or in the form of paper, or is it dematerialized, or whether it's on blockchain, they need to be neutral around, because their mandate is about investor protection and orderly markets, right? And it's a big job making sure that they think through all the issues around it. And as some of the examples that my fellow panelists pointed out, most of the regulators are actually taking these steps to better understand the space and coming up with guidance after guidance. So I do feel that the space is moving in the right direction. Speed, maybe, I think all of us would agree that probably it's not as fast as all of us would like to, but it's just probably because of all of us probably wanting to get this space evolve faster than it is right now.
But Jor, if I may, it's also, what's happening here is we're seeing countries and governments use new laws to pass new laws as a competitive weapon for them to stay relevant at a national and governmental level. This is now what we're seeing. So we see Germany have come out and said that banks in 2020 are going to be able to hold and store Bitcoin and things like this and sell, right? So we're seeing this more and more. So that was only going to instigate more activity in 2020. So more regulation, more adoption, more transparency.
Yeah, and this is actually really interesting. This is not a question I normally would ask, but this is a panel that I think can handle this type of question, which is, I come from the U.S. and everyone's like, oh no, it's the U.S. Let's try to move away from the U.S. to any of these other jurisdictions that have friendlier crypto regulations, friendlier digital assets regulations, and things like that. But there's the difference between kind of regulatorily friendly and just industry friendly, right? And of course, the U.S. is quite a large market. I think all of you guys are in companies that have global reach. And technology, of course, has no jurisdictional boundaries, right? So all the jurisdictional issues we're talking about are largely issues of law and of control and things like that. But since all your businesses touch upon something global, and digital assets and the promise of blockchain is something that crosses jurisdictions, and it's very clear that some jurisdictions are more clear than others, and some are friendlier than others, how does that affect how you guys navigate through your thinking and your product and how you approach the space? And whoever wants to jump in, let's jump in.
Yeah, so I'll jump in on that one. I think you hit it right on the head, which is there are varying degrees of clarity and varying degrees of embracement of blockchain across regulators. And I think that calls for modularity at the product level to be able to adapt on two accounts. One is changes within the regulatory framework of a particular country, and the change across a variety of countries as well. Because as both of you mentioned, regulation is changing, clarity is coming about, and there is a lot of competitiveness across countries to be that next frontier for financial investment, which is extremely positive. So that modularity is one piece, but there is a common ground that is pervasive across all jurisdictions around identity, for instance, which needs to be present across all technologies. And so, we were talking about, in your opening remarks, you were talking about grinding it, and you were talking about finding product market fit. That's really something that, having been in this space for a couple of years now and engaged with hundreds of issuers, what we identified is that there isn't really an existing framework that is suitable for security tokens. You were talking about networks that are pseudonymous. That's a problem when you talk about securities. That's a problem because you cannot touch a security without having gone through KYC AML. There's a privacy issue as well around what are my positions? Can I see everyone's positions? Can I see everyone's trades? Can I front run their trades? There's a governance problem too. You were talking about taxation. If there is a fork on a chain, my asset is now on two branches of that chain, but there's only one company. So what does that mean from a legal liability perspective? What does that mean from a taxation perspective? What's my exposure as a company? And compliance, there's complexity within one singular jurisdictions around a variety of lockup periods and a variety of trading restrictions. But as the work of regulators to enable multi-jurisdictional trades, and GFIN, which is led by the FCA, is spearheading this, which is fantastic. The complexity around that compliance is getting greater and greater. So on the one hand, you have actually, I would qualify it as fast progress from regulators. I think we're seeing them moving way faster than they ever had, and it will never be fast enough for the private sector, right? I mean, for us, it has to be done yesterday. But I think, to their credit, they're moving really, really fast for the most part. So there's a lot of effort that's happening there. How do we create the right framework to support this? And so, that's an initiative that we identified through our product market fit activities, by talking to institutions, by talking to banks, which is, there isn't really a blockchain today that is suitable for security tokens. There needs to be a chain that addresses the issue of governance with the folks and the taxation implications, that addresses the identity challenges, being able to KYC everyone. You should not be able to get on the chain with a pseudonymous identity. You should be able to, you should get KYC and AML before you get onboarded. That addresses privacy of transactions as well. So nobody knows your positions, nobody knows your trade. If you're a market maker in an illiquid market, whatever you hold is your intellectual property. Whatever you do is your intellectual property. And no one should be able to see this transparently. A regulator may want to see trades, and that's perfectly okay. But your competition should not be able to access that. And the fourth one is compliance. How do we, instead of building compliance on top of a ledger that was built for unstoppable applications, for pseudonymity, how do we take those financial primitives, those basic financial components that are going to be pervasive across all jurisdictions, move them down into the ledger, so now we can be even more modular than we were before to embrace new regulation, changes in regulation, new jurisdictions, and multi-jurisdictional trades.
Well, let me jump in on this a little bit because you've mentioned some interesting points about having a blockchain-specific application and things like that. And I know I talked to Dotun last night about kind of architecture a little bit and what could be done and what couldn't be done. And you just talked a little bit about modularity. I was part of the task force that created ERC 1400, which I know you have a product for, and I want to take advantage of this because I know ConsenSys also has its reference implementation of ERC 1400, which is modular, which is designed to be modular. But I also know that, notwithstanding the fact that you guys really spearheaded the development of ERC 1400, you're also now working on your own blockchain. So I'd love to get into kind of a discussion of is ERC 1400, what does that achieve, and what does a purpose-built blockchain kind of achieve beyond that? And Dotun, I'd love, because you're more neutral, I'd love for you to maybe jump in a little bit and see what you're looking at, because as I mentioned to you yesterday, I see London Stock Exchange on all sorts of steering committees and all sorts of standards committees and et cetera globally. So you guys are really getting a good look at a lot of different things and just watching very carefully the space.
Do you want me to just jump in?
Feel free to jump in.
Yeah, no, I think it's an interesting point of discussion as well. I think from our perspective, in some ways, or maybe this is slightly incendiary, right? We kind of see token standards at this stage as being a little bit kind of cart before the horse in some respects. I think really, you need to start with kind of the legal analysis, and I think as my colleague Thomas said, we're in a space today where sovereign control and national sovereignty is a thing. You can't blockchain your way out of it. There will always inevitably be those interests that will remain. They're guiding, a lot of the regulatory governance that exists over financial markets, that has existed over financial markets for a very long time. Even when you're dealing with cryptocurrencies, we're seeing the same, sovereign pressures coming in and essentially establishing rules and regulations and aspects of governance that need to be imposed on the entities engaging within these activities, regardless of whether that's on a decentralized network fabric or not, fundamentally. So I think at this stage, what we see moving forward is kind of from a technology perspective, fragmentation. There are lots of blockchain initiatives being spearheaded from lots of different jurisdictions, trying to solve national problems, cross-border problems, which from a success perspective, we see the national solutions maybe yielding more success in the short term, and then longer term, once these solutions are bedded in and mature and battle tested and have full oversight of the regulators and are happy with it, then over time we'll see some convergence, we'll see solutions trying to tackle with and deal with the cross-border running. And I think it's only once you get to that stage you can really start to get into the weeds of beginning with the legal analysis and understanding of legal structuring, market structures, and then kind of backing that back into how do we design the technology to accommodate that. But ultimately what I see is almost like the technology representing the models that we see in the industry today in terms of how these assets are represented across jurisdictions. If you look at, for example, dual listings, you have various legal structures that can represent that, whether that be ADRs, DRs, CDIs, etc. And I think you'll see similar representations at the technology layer initially, with a view of, as regulation improves, as harmonization increases, as you get more kind of legal models that are cost effective to implement into issues. For example, globally registered shares is an interesting a solution, again very capital intensive for issuing to very large institutions issuing these assets, right? But we will start to see more of a kind of convergence of these types of solutions driven by regulators, but also fundamentally driven by the innovative technology layers that are built out to better facilitate some of these engagements and represent them and kind of operationalize solutions very, very rapidly.
And so do you think that it's too early for standards, or you think that effectively there can be a standard, it just happens to be a very short standard and it evolves?
I think the latter. I think there's utility now. Obviously, security tokens, there's value today on the issuance side of private markets. I think medium term that will eventually move into listed markets and trading, settlement, etc. And then I think over time we'll start to see those standards evolve as more of a concrete understanding of the specific kind of idiosyncrasies of how these assets can be represented across region, how they can move across region, and again it's very, very jurisdictionally contextualized.
Right.
Yes.
Lory,
sorry, I just wanted to add on something because I was ready to pounce on the standards of the cart before the horse, but I figured I'd let you finish. The genesis of this was the industry was moving in all directions. You were talking about fragmentation. And so what that meant was for all the different market participants, it was adding a significant amount of complexity. Of course, we want the market to be successful, which means being able to embrace as many issuances and investors as possible. But if there are multiple ways of representing the same thing, it puts a tremendous amount of burden on those companies. And so the whole idea was, can we agree on something that is going to work today, and then obviously continue to evolve it? One of the things we're seeing with regulation is actually some of the regulation that apply to securities, they're more stringent now on any type of a digital asset. One of the best examples possibly is travel, right? That we're seeing now on crypto payments at $1,000 as opposed to $10,000 on fiat payments. And so how do we, as an industry, speak the same language so we can accommodate those regulatory changes? And that's where, and perhaps calling it standardization is maybe an overstatement, but it provides common grounds so we can start building and focus ourselves on execution and working with the regulators and building that industry, as opposed to spreading ourselves too thin and effectively have multiple competing standards. There will be multiple ways of doing the same thing, but there should not be 10,000 ways of doing the same thing. There's always been, in the history of technology, you look at the internet, there's multiple standards for the same thing, but there's 2, 3, 4 standards, not 50 or 100.
Right.
And I think that's one of the key benefits.
Yeah, Lory, I want to jump to you a little bit because, let's face it, like this really started with Ethereum, not so much Bitcoin, like that allowed us to kind of be where we are today thinking about this. Now, I'm not sure if there's a company that exists that has studied Ethereum more than your company. And I know you guys have adopted 1400 as kind of the reference implementation for your path into digital assets. To the extent that you're aware and you're working on this aspect of it, what was it about 1400 that that was attractive as opposed to like any of the other folks that were trying to come up with similar types of standards? 1400 to my knowledge is I think the only one that's actively being used by someone other than the people that like created it, right? And it seems to have the most adoption throughout the industry. In no small part due to you guys, but thoughts on that before we get into Ethereum or other.
Sure. To go back to 2 seconds on the other question about geographies, right? So as a blockchain product company, our job is to, I guess, find talent that's going to help create products. That's really important, right? So where's all the developer talent in different parts of the world that we can tap into? But also, and most importantly, as a company, where are our clients? So here in the UK, we have a team of nearly 100 people. In France, I think it's nearly 80 people. In New York, it's 300 people or 400 people. And in Ireland, we're about 50 people. So we go to where our clients are and where the talent is. So that's really important to us. And then also, we absolutely look at regulation and we look at that environment. But they go hand in hand, perhaps, with some of the clients that we work with. So to answer that question, that's kind of how we look at things. Similarly in Hong Kong as well, we're building a team out there in light of their forward-leaning approach. So that's how kind of ConsenSys operates in that regard. In terms of standards, a great piece of work started many years ago and before my time in ConsenSys was around the Enterprise Ethereum Alliance. So how do we get companies to work together to drive standards? So that was that big push that went on, and that still goes on. And I guess a recent development of the Enterprise Ethereum Alliance was the Token Taxonomy Initiative, or TTI, to which there are an ever-increasing amount of companies joining up to create standards around digital assets, around tokens. So we have the likes of Accenture and IBM, ConsenSys and Santander, and a whole host of others. And the key thing here, whether it's 1400 or standards more broadly, is it's about getting people in a room, and it's about discussing what are their needs, where do they see this going, what do they want to do, and trying to be as transparent as they can, but without giving away their trade secrets as to where they want to go, what they're working on. But that's where this starts, sitting around a table and communicating that. And then bringing the technologists to understand what's possible, what's not, what didn't work in the past. So that was a key part of this. 1400, to address that question specifically, a lot of work came out of the ConsenSys France team specifically. They did a huge amount of work developing the 1400 initiative and standards around that, and the technology to go with that, based on the interactions that we are having and feedback from clients as to what was required. So this goes back to, I guess, product market fit and fundamentally listening to what was required. So I don't have a terribly more elaborate answer than that, but that's largely it.
Yeah, product market fit was the genesis of it. That's why we brought 25 companies together to kick that initiative off and then give it to the industry. It was seeing that fragmentation around tokenization methodologies, if you will, to try and stay away from the word standard.
But I'd also like to point around kind of Polymath and other companies developing their blockchains. For us, like we're talking billions and even $1 trillion markets here. So this is about, and I know this sounds like cliche, but it is about creating a bigger pie, not us taking a slice away from one another. The pie is going to be significant if it's not already. So having good conversations on this topic with other players in the industry is a positive thing.
Great. And then, let's talk really, just because the conversation is is apparent. I'm staring at the Tezos, logo right now, and there's Polymath on there, there's R3 out there. Obviously, a lot of work started on Ethereum, and Ethereum, was easy because it was there at mass adoption. Then along came other folks that said, no, we think we can use our chain and do something better, and then still some other people came out and said, no, I think that instead of taking one chain and say, yeah, you could do it on that, but is it the most efficient? Is that the best way to do it? Or should you really have a purpose-built chain on it? What are you guys seeing? Citi, London Stock Exchange, maybe you guys are a little bit more neutral in the discussion. What are you seeing as like the necessities, like what is required, and what are the, what we need in the financial world and the capital markets world conflicts sometimes with the crypto ideals that you see still in the Ethereum community, and even some of the other chains that are still trying to, bridge the gap between like we're crypto but we're also finance. What sort of issues, what sort of challenges are you guys seeing and feeling there as you try to innovate without overly innovating?
I think there's this big debate between using public chains versus permission chains, right? At this point of time, our work has been around permission chain and not public chains, and that's been because of variety of reasons dependent on what our business needs are, right? So, and Thomas referred to some of these needs earlier on, right? Some of the things we need in a DLT infrastructure is scalability, right? We do millions of transactions on a daily basis. There is no blockchain that can scale up to that level. We need latency of microseconds or nanoseconds, right? None of the public blockchains is able to offer that as of now. Might change in the future. There are privacy concerns around front running or having the positions being visible to rest of the market participants. And then finally, some of concern that's been flagged right from the very beginning of public chains, the AML issues around it. And until those problems are really solved, I think it's will be difficult to create enterprise level applications on top of public chains. However, if we come down to permission chains, right, most of the work, so we see a lot of consortiums being formed. So while they can scale up to the level, that our business needs are, or can scale up to the level that where our business needs are, and can be controlled to the level that our regulators and rest of the market participants would like to. One concern, right, I see with that approach is that how many consortiums will exist in the world, right? What's the right number? Is it 1, 2, 3, 4, 10? And then we're creating these islands of tech stacks that probably do not operate with each other, so we end up creating the same sort of issues of interoperability that we have right now. I don't know what the answer is, and we'll see how it evolves. But the big challenges right now with respect to implementation are one. I think blockchain is a team sport, right? It's not I can do it alone sport. You need to have multiple organizations aligned to the vision or the approach, right? And that's hard. That takes time because every organization has its own set of constraints around its business needs, what product area they are focusing on, their technology stack, and that becomes hard, and that takes time. The other issues are around in a world where assets are issues settled, transferred over blockchain, right? There are certain roles which are automated, right? Currently, those roles are being performed by entities that are regulated, right? So who will be regulated in that case? Is it the blockchain that's regulated because blockchain is not really an entity? Probably it's the entity that's responsible for the management of the chain, but there are unanswered questions over there. And then finally, right, as I alluded to earlier, right, most of the models, most of what exists in the public chain world, and even to a certain extent, the ideas that are coming up on the permission chains,
the model, the trading model is everything on a pre-funded basis. While it aligns to don't trust but verify ethos of the public chain, but the real world doesn't work like that, right? I mean, bilateral credit arrangements between counterparties in the market is the lifeblood of this industry. Balance sheet is a very scarce resource for all the banks that provide liquidity in the market, right? And with T+1 or T+2 settlement model, we drive massive amounts of balance sheet efficiency, which T+0 actually does not drive those efficiencies. It might actually have the purpose impact of squeezing liquidity away from the market, which will be bad for the customers. So, I mean, and it's still very early to figure out how it evolves, and only time will tell. I think the way it will happen is that I don't think we will see traditional assets moving on to blockchain immediately. Assets like equities, which are fairly liquid, because one, that market works fairly well. I mean, you can debate about corporate actions not being automated or asset servicing bit not being efficient as it would be with blockchain, but it's too big a business risk to rip out the existing plumbing and replace with DLT enabled plumbing, right? Our regulators would not let us do that at a short notice. So I think it's too early to see how market structure will evolve, and there will be a lot of signals and learnings and inputs from the markets and regulators that will drive us to that direction.
Yeah, I think it's a shame that people have confused a technology which is DLT and blockchain with kind of the ideology behind certain use cases of it, or certain factions of people that use it. So a lot of the crypto ideals don't translate very well into kind of our industry in finance and capital markets, where trust and regulation is a very core and crucial. And in the reality, as you said, they're all sovereign nations and they're still going to be around. The technology is not going to eliminate sovereign nations, because whoever has military and police powers and the ability to enforce things generally will take advantage. You could create the most democratic and decentralized technology, but you can't force human nature to change, right? So someone could take